Hello everyone, Matt from Your Financial Coach back here again with another tips and tricks video, and today we're going to be talking about investing. I know some of you are not hardcore into that, some of you do enjoy that, but we're going to be talking about investing and just some tips and tricks on how to help with some of the diversification going along with the Dave Ramsey's plan for how you should be investing in your retirement accounts and even pre-retirement accounts. Anyway, so stick with us on that one. And of course, at the end of the video, I will have a bonus tip for you. Again, all along the same lines of investing, but we'll talk about one first, and then I'll give you some bonus ones. But first, before all of that, make sure you hit that subscribe button down there. That will get you seeing these videos as they come out. Hit the little bell icon, you'll get the notifications. And that also helps promote our videos in YouTube's algorithm so that everyone can see this content. All right, so as many of you will know, when you do investing, according to Dave Ramsey's plan on this, is that you invest into 4 types of mutual funds: growth, aggressive growth, growth and income, and then international or foreign. So those are the different types of mutual funds that you should be investing in. And Dave does recommend investing in mutual funds, not single stocks and some things like that. So good growth, long-term mutual funds that have a track record of 10 to 12% over the lifetime of those mutual funds. So you want the ones that are 20, 30-year track records, and you look at the lifetime, and those things are got a good track record of meeting or beating the S&P 500 is really what you're looking at, which is around 10 to 12% is what you're kind of gunning for that long-term stuff. So anyways, so early on when you first start doing investing, you're probably picking 4, right? One mutual fund in each of those categories. If you have those options within your retirement accounts, especially if you have ones that it depends on what your company is doing or how you're investing in your IRA. If you're investing in an IRA, you should have some pretty good options in there, but you're looking for those 4. As that starts to grow, as your portfolio starts to grow, and over the course of the years, like if you've been investing for over 20 years, as I have, your portfolio starts to get kind of big, and then each one of those mutual funds starts to kind of be a big percentage of your stuff, right? It should be about 25% of your wealth. And that becomes kind of a big number in there. So sometimes those mutual funds, individual ones, can take hits. So you may want to start protecting yourself. So once they get to where you start to be like, yeah, that's a pretty big one, you may want to do is start looking at different mutual funds that meet those criterias within those categories. So you may want to have 2 or 3 in growth, 2 or 3 in growth and income, 2 or 3 in aggressive growth, and 2 or 3 in international. And what that does is that then helps you prevent any one of those mutual funds from having, say, a bad year or a bad couple of years from really tanking. Because a lot of times mutual funds will focus in on a certain segment or in a certain area of the market. And so this, again, is additional diversification that you can do within your accounts to help protect you from any one area. So let's say you have something that's heavy into technology, and technology takes a hit. Think of it like in 2000 when the .com stuff took a big hit, or even more recently, we've had some big hits around the COVID side of things. Of course, everything took a hit there, but there's been little segments that take hits. Think of travel industry during the COVID era. That took a huge hit. So if you were in mutual funds that were focused on travel, you probably didn't do very well in 2020. So anyway, so that's kind of that tip there, is start to spread that out. As your investments grow, start to spread those out across multiple different mutual funds that are in the same category but target different sectors of the market, and that is going to have you have to kind of dig in there a little bit. And so work with a financial advisor, an ELP financial advisor that you can find on Dave Ramsey's site, and they can help you kind of find out a little bit more about those different mutual funds and help you diversify across those. So don't just get the 4, make sure you have multiples across those 4 categories. So That's it. That's your tip for investing today. Again, if you like this video, please leave a like down below. Hit the subscribe button, little bell icon. You'll get notified when we release new videos. And now it is time for your bonus tip. So, as you dig into your different mutual funds, you'll a lot of these ones, they track and tell you what's individual stocks. As if you're not aware, mutual funds are just a group of individual stocks that a portfolio manager or mutual fund manager pulls together, and then they buy and sell based on percentages in their funds and stuff. So we're not trying to get too technical detailed in here, but you'll see a list of all the different stocks in here. So for instance, let's say you have your large cap, these are your growth mutual funds. You see those, and they'll have the list of the different stock portfolio. If one of them, say, includes Apple and Tesla and Facebook and Microsoft, with your other one that fills that same category, the large cap category, don't have Apple and Facebook and Tesla and Microsoft in that one too. Make sure that it has different stocks in there, and that way you're not overlapping within your funds. Because again, the whole point of this is to protect yourself if any one sector of the market takes a dip. Your whole accounts don't also take a dip. You don't want to track that. So anyways, that is your bonus tip. I hope you enjoyed this video. If you do, we will see you in the next one. Bye.